Fitch Ratings just dropped a bombshell that changes everything we thought we knew about silver markets. In a research note published this week, one of the world's top 3 credit rating agencies confirmed what contrarian investors have been whispering about for months. The silver supply deficit isn't just real, it's significantly worse than official estimates suggest. We're not talking about a temporary blip or seasonal shortage. We're talking about a structural deficit that could persist for years, maybe even a decade, as industrial demand explodes while mine production stagnates. And while the mainstream financial media is still focused on gold and Bitcoin, a small group of sophisticated investors are quietly positioning themselves in 3 very specific ways that could generate life-changing returns. If you understand what's happening right now and act decisively, you could be looking at one of the most asymmetric risk-reward opportunities of your investing career. Look, I know everyone's talking about silver lately because prices have been going absolutely crazy. We saw the metal hit all-time highs above $93 per ounce in mid-January 2026, then crash 7%, then recover. It's been a wild ride. But what most people don't realize is that the price action is just noise compared to what's happening beneath the surface. Fitch's analysis confirms that global silver demand exceeded supply by approximately 215 million ounces in 2024, and they're projecting similar or worse deficits through 2026 and potentially beyond. That's roughly 6,700 metric tons of silver that the world consumed but didn't produce. Where did that metal come from? Above ground inventories, stockpiles that have been built up over decades, and those stockpiles are now depleting at an accelerating rate. The Silver Institute, which is the industry's main research organization, has been tracking this deficit for 5 consecutive years. But here's what makes Fitch's confirmation so significant. Fitch doesn't have skin in the game. They're not trying to sell you silver coins or promote mining stocks. They're a credit rating agency whose entire business model depends on accurate, unbiased analysis. When Fitch says there's a structural supply deficit, institutional investors pay attention, pension funds pay attention, sovereign wealth funds pay attention, and that attention is about to translate into massive capital flows into the silver market. Now, before we dive into the 3 specific moves that smart investors are making right now, let's make sure we understand why this supply deficit is happening and why it's so difficult to fix. Silver is unique among commodities because it sits at the intersection of being both a precious metal and an industrial metal. Roughly 50% of silver demand comes from industrial applications: solar panels, electronics, electric vehicles, medical devices, water purification, and increasingly AI data centers. The other 50% comes from investment demand, jewelry, and silverware. This dual nature makes silver incredibly sensitive to both economic cycles and technological trends. On the supply side, here's the critical thing most people miss. About 70% of silver production comes as a byproduct of mining other metals, primarily copper, lead, and zinc. That means silver isn't usually the primary target when mining companies decide to open a new mine. They're looking for copper to meet the demands of electrification and construction. Silver just happens to come along for the ride. So even though silver prices have tripled from $30 to $90 in just over a year, we haven't seen a meaningful supply response. You can't just flip a switch and produce more silver. The supply is fundamentally inelastic in the short to medium term. Meanwhile, industrial demand is exploding. According to the Silver Institute's data, photovoltaic demand alone, that's solar panels, consumed over 200 million ounces of silver in 2025. That represents nearly 30% of total industrial demand. And global solar installations are accelerating, not slowing down. China is building solar capacity at a record pace. The United States just passed major climate legislation incentivizing renewable energy. Europe is racing to reduce dependence on Russian energy. India is massively expanding solar infrastructure. Every single one of those solar panels requires silver paste for the photovoltaic cells because silver has the highest electrical conductivity of any metal. There's research into copper alternatives, but that substitution is years away from large-scale implementation. Then you have electric vehicles, which use roughly twice as much silver as traditional cars because of all the electronic components, battery management systems, sensors, and charging infrastructure. Global EV sales are projected to grow from about 14 million units in 2023 to potentially 40 million or more by 2030. That's an additional 25 to 30 million ounces of annual silver demand just from the automotive sector. Add to that the explosion in AI data centers and high-performance computing. Training GPT-5, Claude 4, or whatever comes next, requires enormous computing power. That means servers packed with processors, memory chips, and circuit boards, all of which use silver for connections and thermal management. As AI deployment accelerates across every industry globally, this source of demand is growing exponentially. So you have industrial demand growing at 5% to 10% annually, while mine supply is essentially flat. That's your deficit. And it's not going away anytime soon, because even if mining companies started investing heavily in new silver projects today, it takes 5 to 10 years to bring a new mine from discovery to production. The supply deficit is baked in for the rest of this decade at minimum. Fitch's confirmation of this reality is what's causing smart investors to position themselves now, before the institutional herd arrives. Now let's talk about the 3 specific moves that sophisticated investors are making right now. I want to be very clear up front. I'm not a financial advisor, this is not financial advice, and you need to do your own research and make decisions based on your own risk tolerance and financial situation. But based on extensive research into institutional buying patterns, retail investor behavior, and analysis of the silver market structure, these are the 3 strategies that keep showing up among investors who really understand what's happening. Move number 1. They're buying physical silver strategically, but not the way most retail investors do it. Here's what I mean. When the average person decides to buy silver, they usually go to a local coin shop or an online dealer and buy whatever's available, American Eagles, Canadian Maples, random rounds, or bars, and that's fine. There's nothing wrong with that approach, but smart investors are being much more strategic. They're focusing on lowest premium products that give them maximum silver content for minimum dollars spent. Right now, that typically means large bars, 100-ounce bars, or even 1,000-ounce commercial bars if they have the capital and storage capability. The reason this matters is premiums. When you buy a 1-ounce American Silver Eagle, you might pay $5 to $8 over spot price. That's a 5% to 9% premium. But when you buy a 100-ounce bar, the premium might only be $1.50 to $2.50 per ounce, which is a 1.6% to 2.8% premium. Over a large purchase, that difference is enormous. If you're buying $50,000 worth of silver, the difference between an 8% premium and a 2% premium is $3,000. That's $3,000 more of actual silver in your possession. And when the supply squeeze really hits, it's the ounces that matter, not the prettiness of the coin. The second element of this strategy is they're buying consistently over time, rather than trying to time the bottom. Silver is notoriously volatile. It can drop 10% in a day and rally 15% the next week. Trying to perfectly time your entry is almost impossible. So instead, sophisticated buyers are dollar cost averaging. They're buying a fixed dollar amount every month or every quarter regardless of price. Maybe it's $5,000 a month, maybe it's $20,000 a quarter, whatever fits their portfolio size. This approach removes emotion from the equation and ensures they're accumulating physical metal consistently through the volatility. The third element, and this is crucial, is they're thinking about storage and liquidity up front. If you're buying large quantities of physical silver, you need a plan. Some investors use allocated storage at facilities like Brinks or Via Mat, where your specific bars are segregated and insured. Others use safe deposit boxes at banks, though that comes with its own risks. Some build secure home storage with heavy safes. The key is having a plan before you buy, so you're not scrambling to figure out where to put 500 ounces of silver when it arrives at your door. And they're keeping detailed records of purchase dates, prices, and serial numbers for both security and eventual tax reporting when they sell. Move number 2, and this is where things get really interesting. Smart investors are buying specific mining stocks, but with a very particular strategy that most retail investors completely miss. Here's the common mistake. When silver prices start rising, amateur investors rush to buy the biggest, most well-known silver mining companies. They see that First Majestic Silver or Pan American Silver or Wheaton Precious Metals are down 20% from their highs, and they think they're getting a bargain. And those might be good companies, but that's not what the smart money is doing. Sophisticated investors are focusing on 3 very specific types of mining companies. First, they're looking for developers, not producers. What's the difference? A producer is a company that's already mining silver and selling it. Their earnings and stock price will increase as silver prices rise, sure. But a developer is a company that's proven, they have a significant silver deposit in the ground, they've completed feasibility studies showing it can be mined profitably, but they haven't started production yet. Why does this matter? Because developers offer massive leverage to silver prices. When silver goes from $30 to $90, a producing mine might see profits triple. But a developer that was uneconomical at $30 and is now highly profitable at $90 might see their stock price increase 10x or 20x because the entire value proposition of the company has changed. The risk, of course, is that developers might not successfully transition to production. They might face permitting delays, environmental challenges, financing issues, or cost overruns. So this is higher risk than buying producers, but the upside potential is also exponentially higher. Smart investors are carefully researching developers with advanced stage projects in mining-friendly jurisdictions, places like Nevada, Idaho, Mexico, or parts of Canada, where permitting is relatively straightforward and political risk is low. The second type of company they're targeting is silver streaming and royalty companies. These are businesses that provide upfront capital to mining companies in exchange for the right to buy a portion of the mine's silver production at a heavily discounted price for the life of the mine. Companies like Wheaton Precious Metals or Franco-Nevada in the gold space. The beautiful thing about this model is that streaming companies get commodity exposure without the operational risk of actually running mines. They don't have to deal with labor disputes, equipment breakdowns, or cost inflation. They just collect their discounted silver and sell it at market prices. As silver prices rise, the spread between what they pay and what they receive expands dramatically, sending profit margins and stock prices soaring. The third type, and this is the most speculative but potentially most rewarding, is explorers who are drilling in known silver districts and announcing results. This is pure speculation. Make no mistake. Most exploration companies fail to find economic deposits, but when one of them does hit a significant discovery in a rising silver price environment, the stock can go up 500% or 1,000% in a matter of months. Smart investors allocate a small portion of their portfolio, maybe 5% to 10%, to a basket of carefully selected exploration plays, knowing that most will be losers, but one or two massive winners can more than make up for it. And here's the key insight that separates sophisticated mining stock investors from amateurs. They're buying during periods of weakness and consolidation, not during euphoric rallies. When silver crashed from $93 to $87 in mid-January, most retail investors panicked and sold their mining stocks. But smart money was buying. They understand that mining stocks are leveraged plays on the commodity, which means they overreact both to the upside and downside. A 7% drop in silver can cause a 15% or 20% drop in mining stocks. That creates buying opportunities if you believe in the long-term supply deficit thesis. Move number 3 is perhaps the most sophisticated, and it's something most retail investors don't even know is possible. They're positioning in silver-linked financial instruments that give them exposure to price appreciation while managing downside risk. I'm talking about things like option strategies, futures spreads, and structured products. Now, I want to be very careful here because these instruments can be complex and risky if you don't understand them. But for investors who take the time to learn, they offer compelling risk-reward profiles. The simplest version is buying call options on silver ETFs like SLV. A call option gives you the right, but not the obligation, to buy SLV shares at a specific price by a specific date. Let's say SLV is trading at $81 and you buy a call option with a $90 strike price expiring in December 2026. You might pay $8 per share for that option. If silver rallies and SLV goes to $120 by December, your option is worth $30, and you've made a 275% return on your options investment. But if silver falls or stays flat, the most you can lose is the $8 you paid for the option. This gives you massive upside leverage with defined downside risk. More sophisticated investors are selling put options on positions they want to own anyway. Here's how that works. Let's say you want to buy a silver mining stock that's currently trading at $15, but you'd prefer to buy it at $12. You can sell a put option at a $12 strike price and collect premium for doing so. If the stock drops to $12, the option gets exercised and you're forced to buy the stock at $12, which was your target price anyway, and you got paid to wait for it. If the stock doesn't drop and stays above $12, the option expires worthless, you keep the premium, and you can repeat the strategy. This is called the wheel strategy, and it's a way to generate income while systematically building positions in assets you believe in. Some investors are also using futures spreads, buying near-term silver futures and simultaneously selling longer-dated futures to profit from the shape of the futures curve. Others are looking at structured products from banks that offer participation in silver upside with principal protection. These products typically say something like, you get 80% of silver's gains over the next 2 years with no downside risk below your initial investment. The catch is you give up some upside and you're taking on counterparty risk with the bank. But for conservative investors who want silver exposure without the volatility, these can be attractive. The common thread across all 3 of these moves is that smart investors are being strategic and systematic, rather than emotional and reactive. They're not trying to get rich quick by gambling on silver hitting $200 next month. They're building positions methodically across physical metal, mining equities, and financial instruments to create diversified exposure to what they believe is a multi-year bull market driven by structural supply deficits. Now let me address the elephant in the room. What could go wrong with this thesis? What are the risks that could derail the silver bull market? First and foremost is demand destruction through substitution. If solar panel manufacturers successfully transition to copper-based photovoltaic cells at scale, that could eliminate 200 million ounces of annual demand. That's enormous. The research is happening right now. Business Insider reported in mid-January that major solar manufacturers are actively working on this because silver at $90 is eating into their profit margins. If substitution happens faster than expected, it completely changes the supply-demand equation. Second risk is recession. If the global economy tips into a serious downturn, industrial demand for silver would fall. Discretionary purchases like solar installations might get delayed. EV sales could slow. Electronics demand could drop. A 10% to 20% reduction in industrial demand would meaningfully ease the supply deficit and put downward pressure on prices. Now, as I mentioned in previous analysis, recession often triggers central bank easing, which can be bullish for precious metals as safe havens. But the initial impact of recession on industrial commodities is usually negative. Third risk is a genuine breakthrough in silver supply. What if a major new silver deposit is discovered and can be brought online quickly? What if improved mining technology makes previously uneconomical deposits profitable? What if government stockpiles are released to stabilize industrial supply chains? Any of these could add significant supply to the market faster than expected. It's unlikely, but not impossible. Fourth risk is China. China is both the world's largest silver consumer and a major producer. Chinese policy decisions around export controls, strategic stockpiling, or industrial subsidies could dramatically impact global markets in unpredictable ways. If China decided to flood global markets with silver to punish Western sanctions on other goods, they have the capacity to do real damage to prices. Geopolitics and commodities are deeply intertwined. And finally, there's valuation risk. Silver has already run up nearly 200% in a year. Even if the fundamental supply deficit is real, markets can overshoot both to the upside and downside. We could be due for a significant correction that sees silver pull back 30% to 40% before eventually resuming the uptrend. If you buy at $90 and it falls to $60, you need to have the conviction and the financial stability to hold through that drawdown. Most retail investors don't. They panic sell at the bottom and lock in losses. So knowing all these risks, why are sophisticated investors still positioning aggressively in silver? Because they believe the probability-weighted expected return is heavily skewed to the upside. Yes, there are scenarios where silver falls, but there are more numerous and more likely scenarios where silver continues rising to $100, $120, or even higher over the next 12 to 24 months. When you're looking at an asset where the bull case could deliver 50% to 100% returns and the bear case might result in 20% to 30% losses, that's an asymmetric bet worth taking, especially if you size your position appropriately and manage risk. The Fitch confirmation of the supply deficit is significant because it removes one of the last objections that skeptics had. People could dismiss the Silver Institute as biased because they represent the industry. People could ignore Goldman Sachs and Citigroup's bullish calls as salesmen trying to generate trading commissions. But when a conservative credit rating agency whose entire reputation depends on accuracy confirms the deficit, it's harder to argue it's just hype, and that credibility attracts institutional capital. Pension funds managing billions of dollars are starting to allocate to commodities as inflation hedges. Sovereign wealth funds are diversifying away from pure financial assets into real assets. Family offices are building positions in precious metals as insurance against monetary instability. These players move slowly and carefully, but once they start moving, they bring enormous capital, and they're reading the same Fitch report we are. So what should you personally do with this information? That depends entirely on your financial situation, risk tolerance, time horizon, and existing portfolio composition. If you have zero exposure to silver or precious metals, it might make sense to allocate a small percentage, maybe 3% to 5% of your portfolio, starting with the most straightforward approach, which is buying physical metal or a silver ETF. If you already have some exposure and want to be more aggressive, you might research some of those mining stocks or developers I mentioned. If you're experienced with options and understand the risks, you could explore those strategies. But whatever you do, don't bet the farm on any single thesis, no matter how compelling it seems. The markets have a way of humbling even the smartest investors when they get overconfident. Position size appropriately. Use stop losses or other risk management techniques. Diversify across multiple approaches. And most importantly, only invest capital you can afford to lose or tie up for an extended period. The silver supply deficit confirmed by Fitch is real. The three moves smart investors are making, strategic physical accumulation, targeted mining stock positions, and sophisticated use of financial instruments, are logical responses to a compelling fundamental setup. But the path from here to $100 or $150 silver won't be a straight line. There will be volatility, drawdowns, and moments of doubt. The investors who succeed will be the ones who have conviction based on research, discipline to stick with their strategy, and patience to let the thesis play out over months and years rather than days and weeks. This could genuinely be one of the most significant commodity opportunities of the decade, or it could be a painful lesson in the dangers of following the herd into an overcrowded trade. The difference will come down to how you position, how you manage risk, and how you respond to the inevitable volatility. What are you planning to do? Are you buying physical silver, looking at mining stocks, or staying on the sidelines? Drop your thoughts in the comments because I'm genuinely curious how this community is thinking about the opportunity. If this breakdown helped clarify what's actually happening in silver markets and gave you actionable ideas you can research further, smash that like button and share this with anyone trying to navigate precious metals investing right now. The supply deficit is confirmed. The question is what you do about it. Thanks for watching, and I'll see you in the next analysis.